The global economy runs on one currency, the US dollar. But what would happen if that system suddenly collapsed? The dollar sits at the center of trade, finance, and international reserves. Imagine waking up one morning to a world in financial freefall. The numbers on every screen flash red. The cost of your morning coffee has doubled overnight. The fuel for your car is suddenly a luxury. This is not a scene from a disaster movie. It is a glimpse into a world where the US dollar has lost its power. For decades, this single currency has been the bedrock of the global economy. It is the language of international trade. It is the safe harbor in financial storms. It is the standard against which other currencies are measured. Its stability is something billions depend on, often without realizing it. This green paper printed in Washington underpins a vast and complex system. It is used to price oil from Saudi Arabia. It is used to buy electronics from South Korea. It is used to pay loans across Africa and across Latin America. Central banks in Berlin and Beijing hold dollars as bedrock reserves of financial health. The US dollar's dominance is not an accident of history. It rests on powerful interconnected pillars. First, reserve currency status. Central banks hold large shares of reserves in dollars. That creates constant, massive demand. They prefer dollar assets to be seen as safe and liquid above all, US treasuries. Second, global trade in dollars. Most cross-border commerce is invoiced and settled in dollars. Key commodities, notably oil, are priced in dollars, the petrodollar dynamic. From raw materials to manufactured goods and services, the dollar lubricates global trade. Third, the unparalleled depth and liquidity of US markets. Equities and bonds can be traded in size, fast. Treasury markets are the world's most liquid benchmark. Finally, institutional trust, laws, property rights, and a relatively independent Federal Reserve. Geopolitical and military reach reinforce confidence in the currency. Together, these pillars cement the dollar at the system's core. Before the dollar, the British pound reigned, reflecting imperial reach. 2 world wars drained Britain's economic strength. The US emerged with industry intact and as the largest creditor. It held a vast share of the world's gold reserves. In 1944, Bretton Woods made the dollar the anchor, convertible to gold at $35 per ounce. Other currencies pegged to the dollar. It sat at finance's center. War and spending raised inflation. Foreign holders questioned US gold backing. In 1971, the Nixon shock severed gold convertibility. Predictions of collapse faded. Trade inertia and oil pricing kept the dollar dominant, now backed by trust and integration. A sudden collapse is unlikely, but a significant sustained decline is possible. A crisis over the debt ceiling and a US default would shatter Treasury's safe asset status. Confidence would erode, triggering rapid outflows. Runaway inflation would erode purchasing power and repel holders of dollars. Central banks and investors would seek alternatives: the euro, the Swiss franc, even gold. A geopolitical pivot, nations coordinating to de-dollarize trade, would chip away at structural demand. New payment systems and commodity pricing in other currencies would reinforce the shift. Severe political instability, a breakdown in rule of law, or a deep recession would undermine confidence. These triggers can reinforce each other. Debt, inflation, and geopolitics combining into a perfect storm. Global trade would be hit first. With the transaction currency unstable, pricing becomes a nightmare. From Brazilian soybeans to Taiwanese microchips, costs would swing wildly. Friction would shrink trade volumes and slow growth worldwide. Investors hold trillions in US assets, stocks, bonds, real estate. A falling dollar would slash values in home currencies, spurring exits and intensifying the slide. Oil priced in dollars could see producers raise dollar prices, fueling global inflation. Dollar debts would bite. Devalued local currencies have historically turned stresses into sovereign crises. Americans would feel it in wallets, imported goods, travel, and energy costs rising. Any export boost would be outweighed by instability and higher borrowing costs. The euro is the obvious candidate, but political fragmentation and no common treasury limit its safe haven appeal. China's yuan benefits from scale and trade links, yet capital controls and governance concerns curb global trust. Gold is a timeless store of value, but a gold standard lacks flexibility for a vast digital economy. Most likely is a messy multi-currency system: dollar, euro, yuan, yen, franc, more fragmented and volatile. The transition would be complex and uncertain for years. Despite risks, the dollar remains remarkably resilient today. There is no viable alternative. Scale, liquidity, treasuries as the risk-free benchmark, and network effects keep it central. Institutional credibility and U.S. influence reinforce that position, especially in crises. A sudden collapse would unleash instability worldwide, but such a scenario is unlikely to unfold overnight. Thanks for watching Wallet Economics. Please subscribe to Wallet Economics to understand the system.